Hello, and welcome to today's webinar. I'm Nick Zulovich, part of the team at Cherokee Media Group and senior editor at AutoFin Journal. In today's webinar, auto lenders prepare for delinquencies and defaults, strategies to implement now, and compliance risks to avoid. We're going to learn more from Carissa Robb of Constant and Paul Mattiacci of Oracle. But before we get started, I wanted to go over just a couple of quick housekeeping items for today's webinar. We are recording today's session, and we will make the recording available to you as soon as possible. So keep watch of your inbox for a message to a link to that recording so you can review the great presentation and share it with other individuals at your institution. And to make best use of our time today, our presenters will share their contact information at the end of the presentation, so you can reach out directly if you have any questions or would like to follow up with our experts who are on hand today. So with plenty of knowledge and recommendations to share, let's get right to Carissa and Paul for our webinar. The floor is now yours.
Excellent, thanks very much. Paul, I'll let you kick it off today.
Well, thank you, Nick. Thank you, Carissa. Appreciate it. On behalf of Oracle, I'm very excited to be part of this webinar. We have some great topics to discuss today, so let's get started. So we're going to cover basically 4 different areas in our discussion today. First, let's talk about the current state. We'll take a close look on how the current economic environment and the duration of the government relief programs may impact the auto industry and potential loss exposure. Next, we'll talk about the shape of the recession. This is our alphabet soup. We'll explore the likelihood and factors that contribute to the V, the U, the W, and L-shaped recessions and recovery periods, and discuss what auto lenders should be preparing for. Thirdly, we'll talk about credit and compliance risk. As regulatory exams continue, we'll look at the trending of customer and consumer complaints, consumer protection laws, and operational exposures to regulate non-compliance. And finally, strategic playbook. We'll talk about the playbook and critical strategic updates that can be made to enhance or create loss mitigation programs before ending with a demo of the Constant solution, helping financial service providers respond to the crisis. Let's cover our first topic.
Perfect. Before we get started, Paul, I just wanted to open up a quick polling question and actually gauge the level of activity for some of our participants today surrounding hardships. If you take a look at your screen, we'll have a quick question. How many loans are currently in a short-term relief program, for example, an extension or forbearance or deferment? You'll see the options, 4 options, just choose the best fit, and we'll get started with the content. Give folks just a few more seconds to get their answers in. Great, and Paul, we'll kick it back to you to cover the landscape.
Great, thanks, Carissa. So what's the impact on auto lenders? In the current situation we're facing today, there is a high degree of uncertainty and extended time frame where downside risks are likely to play out. This is impacting all of us, especially financial services operations, and we'll cover that in more degree. What are consumers expecting? They're expecting relief, either sustained or continued through government programs, as reopening plans remain uncertain, or through lenders to restructure debt obligations. And lastly, short time frame for addressing default, 90 to 120-day windows, sharp increases of loss provisions, and capital moving to reserves instead of lending or other revenue drivers. This is the information that we talk when we talk about with our lending clients. Here's some interesting information. I find this very interesting. I look at Fitch and some of the details that they have. As we all know, unemployment is on the rise. Roughly 30 million folks are unemployed, which is basically almost 20% of the labor force. This influx of cash is hedging default risk in subprime. We don't know. Repayment obligations are relieved by getting this cash or short-term deferments, and extensions is not a sustainable long-term strategy. It's interesting that the rates from a delinquency standpoint have decreased, and this is information from August of 2020. The reaction of this biggest unemployment crisis should have caused delinquency rates to spike. But despite tens of millions of people losing their jobs, the opposite has happened. Households find themselves making more than regular employment levels and maintaining monthly obligations becoming easier than before, despite our pandemic crash. As we rip these Band-Aids, we'll need to have updated strategies to remedy lost exposure.
Thanks, Paul.
Now let me turn this over to Carissa.
Thanks, Paul. I want to pull that thread a little bit on the impending credit risk. As Paul was talking about, maintaining the loss provisions on our existing debt is one thing. The problem actually compounds when you introduce the dormant credit risk that's lying behind new near-term and future originations. So when we think about credit bureau attributes and the models that we use today and historically, those were our primary indicators for determining creditworthiness. That picture may now actually be a bit distorted due to a combination of external factors. Forbearance plans, stimulus dollars, all of those are providing relief and certainly easing the burden of monthly obligations. So what that's doing is temporarily distorting the true ability of a borrower to manage their debt. So we're kind of missing the full picture on the ability to pay via income disruption on top of the temporary relief programs. So these graphs from Experian are a good snapshot that just shows some of the volatility around credit bureaus. FICOs were trending down in the first quarter of 2020 and then suddenly rebounding in parallel with relief groups. You'll notice quite a significant increase on the new auto loan scores between this time last year. So these are things that are important to understand and acknowledge so that the credit risk profiles, not only for the existing debt, but for future credit decisions can adjust. There was a September article actually in Credit Union Times that commented on uneven impacts of the recession on the auto industry in particular. I'll quote the article that another curious artifact of this command recession is that many borrowers have maintained good credit scores even without jobs, thanks to the boost from the $600 a week federal unemployment benefit and lender forbearances. So with this existing risk and the imminent risk of near-term origination for some of the portfolio or eligible consumers, having relief options to manage through those credit blind spots will be critical, as we'll need to kind of expand the credit models, look at non-traditional data points, and supplement some of those weaknesses that may occur over the next few quarters. What was a 640 in early 2020 may now be in a 680 range, despite no changes really to credit worthiness, but those external factors supplementing and assisting with ability to repay. Paul, I'll kick it back to you. We can jump into the shape of the recession and the volatility there on some of the industry recommendations and expectations. And Paul, you may be on mute.
Yeah, I'm sorry about that. Yeah,
Yep.
So there was there's a lot of information on the marketplace on recovery, and a lot of people have heard of the V shape and the U shape recovery. There have been studies. E&Y did one back in March of 2020. Looked at from leading executives in the industry about these different types of recessions. Really the duration of this economic downturn is largely unknown, as we might be in the beginning of the recovery period. But for financial service providers like yourself, responsible for responding to consumer demands, preparing for an optimistic V shape, despite the external factors and macro outcomes for it to happen, is somewhat irresponsible. We don't really know on really what is the next steps, whether it's a V shape or W shape. We kind of call this the alphabet soup. In that survey, 38% thought V shape was going to be the result of our situation today, which is best case. These are really optimistic view for rapid recovery, supported by government relief and sustained in the normal job market. As we move down into the U shape, it's really recovery extends several months or years. It's influenced by stay-at-home orders, schooling and state level reopening plans, as well as consumer behavior. Will borrowers be willing to spend as we slowly enter an upswing? As an example, back in history, if you remember, the Great Recession lasted 19 months and returned to normal several years after that. So it's a lot of impact, whether it's going to be V shape or U shape. As we move into W, that's a double dip recession. It's rapid recovery, and then it has a second decline. This could be influenced by weather or the stock market rebounds or the second round of infections causing additional job loss and disruption. We have seen that data, that 54% will believe it's going to be a U shape. L shape is really where we hope will not occur. That's really sustained downturn, growth falls and does not recover for years. Really, what letter would be our future? It's the best guess at this point in our belief, but there's nothing barring investors and servicers to plan for the W-shaped rebound, rather than kicking the can on losses and hoping for a faster recovery than we can guarantee at this point.
Excellent.
Chris?
Thanks so much. Before we jump into consumer expectations and build off of what Paul just shared on the shape of the recovery, we do want to get your opinion on another topic. So you'll see the poll question pop up in just a moment. When do you expect to start foreclosure, repossession, or litigation activity for defaulted loans? Your choices there: you've already started, imminently starting, or somewhat deferred, perhaps March of 2021 or after. Go ahead and take your best guess. We'll give folks a few minutes to get their answers in, and then we'll jump into consumer expectations. Okay, let's go ahead and move that forward. Perfect. So it looks like, just to share a few results, it looks like the majority, 76% of participants that responded have actually already started pursuing collection consequences and collecting on the note with legal action. So great to get that feedback, and we'll move forward into some consumer expectations around that topic. So I wanted to share with you, we keep a fairly close eye on CFPB complaints for two reasons. One, it's an invaluable source of what the industry is potentially failing to deliver to consumers today from the consumer perspective. We all know there's two sides to each complaint response, but we try to keep a really close eye on consumer expectations and their interpretation to influence our roadmap and make sure that we help the industry stay abreast of those demands and needs. The other benefit is to really understand where consumer expectations are trending. You'll see in this chart, there was a drastic increase in consumer complaints to the CFPB in the category of struggling to repay loans. Obviously, that's paralleled to the macro impact of COVID, as that started to reach households at a very personal level. So you can see the bouts of downward trends that as those extensions and forbearance plans started to go into effect and lenders started to respond with solutions, consumer complaints started to move down. What we should be prepared for is, as those start to expire, it's not unreasonable to see that trend line reverse in the very near term, and borrowers will seek protection from oversight entities to simply keep their head above water. So the importance of self-service, collaboration, transparency with your consumer portfolios will become increasingly important. And what we can draw from this and the certainty, and certainly from other data points around unemployment trends, is that consumers are really still expecting additional relief via government programs and certainly partnership with their lenders. So the view of payment obligations as a responsibility is actually dwindling right now. The reality is a very strong expectation, some even suggesting perhaps a bit of entitlement for restructuring or forgiving or deferring those obligations. So it's important to just keep an eye on the pulse of those consumer expectations that will allow us to kind of drive the strategy that we need to respond. We saw this in the last crisis with strategic defaults kind of compounding and complicating the pipeline. And what that did was just create additional manual burden for specifically in the mortgage market for the operational folks to respond to. So monitoring this activity and lender responses will be critical as we move into the next few phases. This regulatory compliance side is something that's we're really passionate about. There are millions of Americans in deferral programs. There's a real urgency, not just for mortgage customers, but all consumers. All consumers are at risk of a somewhat volatile financial hardship experience over the next several quarters and potentially years. So there's a real sense of urgency here for financial service providers to prepare not just for the consumer pressure, but also the regulatory pressure to meet and maintain those customer service expectations. When there's a kind of a macro event, natural disaster, there's always a bit of confusion around interagency guidance that offers reprieve from criticism for lenders to respond quickly to the crisis. That's usually geared in a financial aspect and to say, hey, we support you, we're in your corner, help your consumers. Where there's confusion is that doesn't remediate any expectation for sound processes, sound operational controls, specifically geared towards preserving consumer protection laws. Those are not things we ever get a free pass on. And so as we start to roll out relief programs, the way that we roll that out, the transparency of explaining that to a consumer, the control we have on the decision engine and the obligations that we're reviewing become critically important to prevent consumer harm. So exams are already kicking off. We're already seeing failure points, lack of automated workflow in most of the servicing cores, manual Excel tracking, files are getting lost, consumers are getting approved for relief options they never asked for or didn't fully understand. And then on the flip side, you've got others that were expecting relief and due to dropped files or manual errors are not seeing that come to fruition on their actual loan level obligation. So all of these errors are a result of best intentions, but an unprecedented volume that is very difficult to maintain with manual workforce and FTE campaigns to kind of keep everyone's head afloat. And all of these errors are all exposing consumers. So we've heard from industry expectations of folks that are kind of hedging their bets that this will be over in another quarter. And until then, the Band-Aid of short-term extensions just continues to be offered on somewhat of a perpetual basis. Some extending obligations 4 to 6 months. And again, best efforts trying to respond to consumer need. But what we're seeing is there's not really a true understanding of the micro hardship that is impacting the person, that's impacting the household, and subsequently impacting the loan. At some point, and Paul touched on this earlier, the relief options will expire. The burden to show willingness and ability to repay, rather than continuously kind of kicking the can on losses, will start to resurface. This is a lesson that we learned as an industry at an incredible cost to mortgage servicers and consumers, and one that I think we should be prepared to learn and perhaps respond more gracefully to for the consumer and auto market as we start to see some of those parallels from the Great Recession come forward. If there's any takeaway from our time here today, it's preparing for UDAP for those consumer protection laws should really be the driver, the focal point of a loss mitigation strategy. It's always about preserving revenue and mitigating losses, but At the core of this is ensuring fair and equitable relief options available to everyone that qualifies, and that those solutions are appropriate and to the benefit of the consumer. That takes experience. It takes a very focused strategy that has credit losses in mind, but the consumer at the center point. So I wanted to share a quick quote with you and just set the stage. We've kind of set the stage on all of the challenges and potholes to avoid. This quote, a lender has a choice. I came across it last week. A lender has a choice: either work with the customer or repossess the car, sell it at auction, use the proceeds to cover part of the outstanding loan, and write off the rest of the loan. That can get costly. The cheaper for now route is to work with the customer by putting the loan, whether it's already delinquent or getting ready to become delinquent, into a deferral program. This kicks the can down the road. So before I jump into, I just wanted to set the stage with that quote before we jump into some playbook strategies. But let's take one more polling question. I'll give it a second to pop up. With extension and deferral programs expiring, which would you consider offering to your customers that are still requiring assistance? Rate reduction, term extension, settlement or forgiveness of principal, all of the above, or none of the above? We'll give folks a few more seconds to respond, and then we'll jump into some strategic playbook strategies and a quick demo of how we can show automated loss mitigation. Perfect. So looks like almost half offering term extensions, preserving the rate, and then perhaps just extending the amortization period to get an affordable target payment. And a fairly good percentage are offering all of the above. So great to see that there's flexibility and attention paid towards updating those strategic playbooks. So I've touched on this, Paul and I probably both touched on this topic a couple of times already, but I really want to connect the dots on moving from macroeconomic impacts to micro hardships. And how we tie the severity and the duration of a hardship to a relief option. I mentioned it in the compliance side, as far as making sure solutions are appropriate and to the benefit of the consumer. And then also when we were talking about what to prepare for in terms of economic downturn and recovery. I'll demo how we've done this in a moment. But the key element that's typically missing from most loss mitigation strategies on the consumer side is precision and data. So most of that is because introducing precise underwriting was quite cost prohibitive, super manual on lower dollar balances. So now, just as the industry has made progress in automating origination activity, we can start to bring these tools, validation of income, electronic integrations for substantiating ability to pay, we can bring those tools forward into the back office and the operational credit decisions of mitigating a loss. When you think about the uncertainty around the stimulus packages, it's been all over the news, and the likelihood of at least one more effort to supplement income in a major way for the millions of folks that are in need right now, failing to look more closely at the hardship is actually somewhat perpetuating and kicking the can again on losses, but more importantly, on the true impact of what's happening to your customers and to your portfolios. So the one-size-fits-all solutions or one-size-fits-most solutions have very little barriers to entry. There's very little engagement and understanding of the precise hardship, the micro hardship happening to that person. And all of that data that could be extracted from a self-service opportunity to engage and dig in a little bit deeper is preventing us from telling a story that is a bit more accurate. Right now, you've seen all of the articles that loss provisions are a bit of a guess. We're in, again, another blind spot. So opening up the ability to collect kind of non-traditional data, engage in that hardship analysis and story could help us be a little bit more precise in preparing for the future. I mentioned this before, we need to be prepared for the ebbs and the flows of solvency and distress. And failing to do that is somewhat resemblant of our failure to prepare for the last crisis. It was very reactive to what we were seeing. And I think now with the help of automation and AI, we can take a step forward in our preparation. So we'll take a look as I start to get the demo up at a few options. It sounds like most folks are already expanding their loss mitigation strategy beyond just the 1 or 2 month extension. We have seen a lot of different opportunities. One is allowing for recast or re-age for nominal fees for those current customers that are just looking to reset their payment rather than going through a refinance. Introducing short payoffs where keeping the vehicle is just no longer appropriate. And looking at an amicable exit, whether that's voluntary surrender or just simply time to sell. And then lastly, what we've been focusing on today is just restructuring that debt as deferrals start to expire, not just in bankruptcy, which is where the restructures typically hit, but in the course of evaluating those hardships and the ability to repay. So I'm going to jump into a demo. And this will be a truncated demo. We'll share our information at the end of this for a more expansive view of the tool. But we wanted to leave you with something to give you a sense of how automation can help you manage these volumes, whether it's V-shaped, U-shaped, W. It's really preparing for your consumer. So it's less about what the market's going to do. It's more about a responsible playbook for your consumers. So I'll drive you through this demonstration as a consumer. And this is all self-service, so embedded within your online banking service, available to your customers with your own brand. So we'll ingest information, and then we'll just ask a series of questions to get a little bit more granular on what's going on with that consumer. We have options, this is for demo purposes, to go down the path of restructuring or voluntary repossession or surrender. And then here is where we culminate all of that information around the hardship and the duration of that hardship. So if you're on unemployment, you'll ask a series of questions so that you can make sure if they're not expecting unemployment, that you're not offering them a long-term modification or a step-up modification that will eventually be unaffordable. If you're talking about increased housing expenses, is it one-time or ongoing? And so the precision here allows you to kind of move forward based on the hardship and really get into the right solution that will remediate the risk of default for this consumer. We'll go quickly down the path of reduced income, long-term hardship. And this is a new feature that we've introduced to the market. Instead of collecting documents and chasing paper, we'll actually allow the consumer to open and record a quick video that we'll then take a transcript of. So I was impacted by COVID. I'm now back to work. I'm unable to make my payments because I'm not receiving overtime. I just need a little bit of help before I can get back on track. That will be saved as part of the audit trail. You'll have a transcript to accompany it. And then now we'll move into the assessment of income. So we'll start with stated income. And then we have integrated partners that are entirely configurable at the client level to help us substantiate that information. So I'm logging in as the consumer to get read-only access to my account, deposit account, and substantiate that $3,000 that I just put in. They can add as many accounts as they'd like. And then we'll do the credit policy review in the background. So here we're supplementing information to strengthen our understanding of the ability to repay. You can pull the consumer income view, you can pull the Equifax soft inquiry, analyze the attributes that you've extracted from Plaid. All of this is configurable to really understand how to help the consumer. If there are any discrepancies between the stated income and the integrations that you're using to substantiate it, you can simply ask them to upload proof of income. And then now we'll get into the analysis of what's really going to help this consumer. So this specific investor has configured step-up payments. So for the next 6 months, they can go as low as $25. So it's allowing the consumer to come in and engage and say, in comparison to my regular scheduled payment, I can pay a lesser amount within the bounds that are set by the client. This allows for ACH to continue. It allows for the borrower to prioritize their debt rather than simply kicking the can or having that obligation entirely removed. And then we'll make sure that the analysis continues for that step-up period. So we saw this in the mortgage crisis of interim relief options that were not sustainable. There's a second credit call that makes sure if there's any adjustments that are needed to make sure that the loan is affordable long-term, that waterfall is applied to achieve that target payment. So accepting the offer, you can set conditional or final approval. And then upon final approval, they can actually do an in-browser signature. So the entire process that's typically reserved for mortgages and extremely manual can now be accomplished in just a matter of minutes. So that's just a quick example of how we show up with automated tools to help our partners in the financial services industry sustain this obligation and these unprecedented volumes. The very similar paths for all of these features, voluntary surrender, etc. So we're happy to share a little bit more information and do some extended demos. And we'll share our contact information here. Happy to continue all of these conversations as we move into the next few quarters of the downturn.
Carissa, Paul, thank you so much for the great presentation. And just a reminder that we are recording today's session, so please keep watch of your inbox for a link to that recording so you can review the great presentation and information that's been shared, and as well as share it around your shop so you can formulate the playbook that best works for your operation. And with the time that we have today, just a couple of questions for each of our experts, and Carissa, we'll continue with you. During the presentation, you referenced the different shaped recessions that typically occur and connected with various letters of the alphabet. What, if anything, can finance companies and servicers add to their playbooks now that will prepare them for whatever shape recession we end up experiencing?
Sure, great question. So there's a few features that are important. One is addressing the ability to restructure the debt, modify to affordable payments. Those activities are sometimes reserved for bankruptcy cram downs or reaffirmation agreements. So expanding that strategy so that you can have the appropriate gating requirements and eligibility rules is always a good indication to maintain borrower collaboration and engagement. And then the second set of options is really on the non-retention side. And what I mean by that is when keeping the collateral is no longer affordable or sustainable, how do you maximize your chance of recovery from the collateral? Offering solutions to voluntarily surrender that, to short payoff, time to sell, are all ways that can preserve or mitigate loss exposure and prevent the banks from having to become car owners in a market that's extremely volatile on the secondary market.
Well, thank you, Carissa. And Paul, let's bring you back into the conversation here. As you referenced earlier, certainly the data that's been generated about the auto finance space is kind of a head scratcher to a degree in light of everything that's happening. With deferrals, perhaps masking some of the credit risk in terms of bureau reporting and other data sources. Just what are your thoughts about the short and medium term risk of originating credit that institutions are taking on nowadays?
Yeah, very good question. And Carissa kind of, explained that and touched on that during her presentation. As consumers are getting extended and processing deferments, and now they're considered current, from their existing loan. And, that could have an impact on new originations as lenders look at credit information, right? I mean, the consumer's credit scores, their history could be much better than it is actually, part of what their experience is in today's world. So, these factors, along with other factors, could, basically impact the ability to pay, the creditworthiness of the consumer. So there are both short-term and midterm risks to the lender. Potentially, there might extend credit to consumers that might not have the ability to pay, which then will drive, additional delinquencies and potential repossessions and losses. So it's something that lenders need to be aware of, as in today's world with the extensions and deferments that are being processed on consumer loans, that there is an impact for future origination. So something that lenders need to be aware of and take good consideration from a risk standpoint while they're basically performing and producing new loans.
Very good. Again, the voices that you're hearing are special guests for today's webinar: Paul Mattiacci of Oracle and Carissa Robb from Constant. Today's session titled "Auto Lenders Prepare for Delinquencies and Defaults: Strategies to Implement Now and Compliance Risks to Avoid." And Paul, let's continue on with you here. Again, measuring risk and activities. Some institutions are in the industry are pushing more refinancing as extensions and deferrals expire. What's your sense? Why is a recast and a restructure better? How can institutions choose which path to take with their client bases?
Another good question. As we are spending time and speaking with our auto finance companies. I mean, it really depends on the consumer. I mean, there has to be an evaluation of the risk on the consumer, whether to provide refinancing or just recasting or re-amortizing the current balance. So it's really, I mean, the last thing the lender wants is to take possession of the automobile, through some repossession or loss mitigation strategies. So if they can keep the consumer in their vehicle, having the consumer continue to make payments on their loan, they have to look at whether a refinance is the best option or a recast. I mean, with a recast, it might be for the lender itself, a much simpler and cheaper process than doing a complete refi. They might be able to assess a fee for the recast, but still allowing the consumer to continue their loan payments. Potentially that loan payment, based on the current status of that loan, potentially could increase the monthly payment. But so if they have the ability to pay a higher rate, keeping the term the same without extending the maturity date, that's an option. So we're starting to see a lot of lenders offering more of a recast or re-amortization of the current program or current loan versus going through a time consuming refinance and process. So that's really kind of what we've seen in discussions with our auto finance customers.
Good, very good. Well, thank you, Paul, and Carissa. We'll wrap up with you, if you could. The closing slide of your presentation had your contact information there. It is on the screen, her email address and phone number to make any follow-up questions that you might have for Carissa and the team at Constance directly. Just to wrap us up, Carissa, if you could, again, the regulatory and compliance components of operations certainly can be complicated. Just what do you see as the the major regulatory and compliance issues do you see potentially surfacing within consumer credit and the auto finance segments that solutions are geared to mitigate?
Sure. It's always going to be focused around consumer protection, and rightly so after the injuries and consumer harm that we went through and saw folks experiencing from the last crisis. So I think there will be two major views. One is, are you honoring the programs that you're offering? Are they accessible? Are they transparent? Are they clearly disclosed as far as the impacts of interest revenue, et cetera? And the second is it helpful, right? Are we truly trying to address consumer need, or are we trying to only focus on preserving PCLs? Those are different goals. Not that the other one is inappropriate, but they have to move forward together. So we need to look at how we help the macro state of the industry, the micro state of your consumers, your customers, your people. And how do you tie those solutions in a way that's appropriate, responsible, and also helping the bottom line and preserving revenue opportunities and mitigating loss.
That's Carissa Robb of Constant and Paul Mattiacci from Oracle. Carissa, Paul, thank you so much for sharing your information and perspectives during certainly unprecedented times for all of us. Thank you so much.
Thank you for having us. It was a pleasure.
Well, thank you again so much for joining us. And on behalf of all of us at Cherokee Media Group, I'm Nick Zulovich. We thank you for joining us, and we look forward to having you again next time.